Hello and welcome to FinTechTalk. I'm your host, Charles Alton-Jones. Today we're looking at the weird and wonderful world of central bank digital currencies, these CBCDs. There is tremendous fascination worldwide around these pseudo-cryptocurrencies, but if you're arriving to this show with not a great deal of knowledge about them, well, you're not alone. They are in development. 19 of the G20 have a central bank digital currency in an advanced stage, but really very few have launched. I think we have something like 6 worldwide. I'm open to correction on that. China has the digital yuan, Nigeria has the e-naira. But what is the impact going to be? I mean, what is the point of these things? It's a question which even some central bankers can struggle to answer. Well, to fill you in, we've assembled a wonderful panel. So we have 2 experts on CBCDs who are going to talk you through exactly what they're for and what the real impact is going to be. And I have to say, during rehearsal, we started to discuss the currencies, and it's one of the most interesting rehearsals I've ever experienced. Some of the issues, such as the impact of negative interest rates, were things I've simply never heard discussed anywhere else. So without further ado, let me welcome my panel. We have Dr. Ritesh Jain, who is the founder of Infinite. Ritesh, if you turn on your mic and camera. Ritesh founded a fintech, Infinite, which helps consumers manage and lower their credit card debt. He's also a member advisor of the Global Partnership for Financial Inclusion and recognized in India as one of the foremost spokespeople on fintech, on CBCDs, and a number of other issues. So, Ritesh, how are you doing? How's your connection? We had a little bit of glitch in rehearsal, so how are you, sir?
I'm very well, thanks, Charles, and hope you're well as well.
Very well indeed. And I also welcome David Gyuri, who is the founder and CEO of Banking Reports London. David is a familiar face to those of you who watch the show. Banking Reports London has been training CEOs, boards, and executives in banking and fintech in over 50 countries for more than a decade. So if you want to upskill your staff, David is the man to talk to. David, lovely to see you.
Yes, it's great to be here, and I am very excited to talk to Ritesh and you. And also, I will be very happy to take some questions from the audience.
Absolutely, let's hear it. If you're watching this and have a question, the more awkward, the better. Feel free to ask our panel. And David, let me give you the hot potato to begin with. Just talk us through CBCDs, what they are. I mean, the Bank of England's one is nicknamed Britcoin. Is that right? Are they just cryptocurrencies controlled by the government?
Right. So monetary innovations throughout history have been originating from private entities because they are more agile, they are under more pressure of solving problems and so on. However, throughout monetary history, these privately originated innovations tended to end up in the hands of the sovereigns, the states, the kings, the governments, or in modern days, the independent central banks. So there is an underlying historic pattern in monetary innovations. When in October 2008, at the height of the global financial crisis, the Nakamoto white paper, cryptographically describing Bitcoin, started to circulate around the internet. At that time, an innovation was born. And according to this underlying major pattern, this innovation sooner or later, probably sooner, will morph into a compliant, sovereign controlled thing. And that is CBDC, that is central bank digital currency. Now, there is retail CBDC, wholesale CBDC. Ritesh will tell you much more about this. I want to point out something very important. Retail CBDC is basically the digital form of cash, direct liability of the central bank. in digital form. So the first coins were issued around 3,000 years ago. The first paper money was printed in China by the Tang dynasty in 745 AD, around 1,300 years ago. So 3,000, 1,300. Now, CBDCs will sooner or later, in my humble opinion, substitute this physical cash.
Okay, so they are the future. Ritesh, how do you see it? I mean, David made the distinction between retail CBCDs that we're going to use, for everyday purposes, and a more institutional level, such as, bond clearing and coupon payments. How do you see it, Ritesh? Is that the way it is?
Yes, thanks, Charles. It's the way it is, right? So there are different forms of the CBDCs, or how we define it, especially as per the uses of the CBDCs. So thanks, David, for explaining the CBDCs. And as you rightly asked, whether it's a cryptocurrency regulated by central banks, yes. I wouldn't say it directly as a cryptocurrency, but it's a digital form of the money, right? Now, the basic difference between the retail and the institutional or the wholesale, retail is basically distributed across as we use our cash in a day in and day out, or even the mobile payments. So basically, you will be able to utilize your digital cash, utilizing your devices at a different touch points, right? So we can get rid of cash to an extent. And I'm being very careful when I say to an extent, right? I'll come back to that in a minute. Now, from the wholesale perspective, it's a better and much more excellent as well as usable use case for the CBDCs to be in wholesale. Why so? Regardless of the transformation across the payment industry or the businesses or the financial services, right? The banks still do transfer trillions of money every night from one entity to other entities, and that's what happened. And that is the onus onto the banks, the large financial institution. Let's be realistic, it is not the fintechs, right? And how that can be done, it is done in a digital form today, but from the programmable money or from the smart contracts that can be done even at a lower level in a day-to-day activity. And that's where we are coming with the wholesale CBDC or use of the CBDC in the businesses and commerce. Now, the fundamental challenge comes around the retail side. We have seen multiple examples of the central bank digital currencies already in play, from China to Caribbean to Nigeria and recently India. The biggest challenge that I've seen across the regions, we have studied all the reasons pretty much in depth, but it's a general consensus. The problem is when you talk about anything which is going to the retail customers, you need to educate them. You need to understand that what they need. And the biggest flaw in the whole CBDC gamut is the customer use. There's a huge gap in the customer expectation versus what's been offered to them. And in the retail CBDC, and hence, in different economies, the retail CBDC adoption is very, very slow. So let me give you an example about India, right? Because when we talk about the digital payments, you start and stop at India because of the UPI, which is the Unified Payment Interface. It has changed the face of the country in terms of the digital payments, not only in country in India, but globally as well. Right? So the UPI is going to the 20 different economies. Now, the challenge in India, because we are pretty solid in terms of the payment infrastructure, that is UPI, and that is in rotation. So people are used to, from your roadside vendor or to anybody, even for the minor change, they just use the UPI because it has no cost associated with it and a solid infrastructure and no cost to the merchants as well. So it works well for the customer. Now, if you want customer to adopt a digital cash, the question is, why do I need this? Why would I go for the digital cash? Right? So in economies where the digital public infrastructure is predominant, and well established, the retail CBDCs will have a slight challenge in terms of the adoption. That's what I see in experience in the
Okay.
various economies.
Let me put that to David, because I mean, that's the way I feel, that I'm still struggling to see the use case on the retail side. If you're in the UK or Estonia, where I currently am, the payment infrastructure is already really excellent. And if you look at SEPA instant payments coming in, well, okay, where's the progression here? So, David, just looking at the retail aspect of CBCDs, what's the killer app? What's the point of it? What we've already got works so well.
Right. This is a very important question. And a couple of months ago, I was advising the CEO of a market leading bank in Europe exactly about this. So the question he asked me, this CEO, is CBDC a solution looking for a problem? And I said, let's think it through. There are two questions here, and we have to understand the answer to both in order to understand that CBDC is a genuine solution, retail CBDC. It is more than a solution looking for a problem, as this very smart CEO implicitly with his question might have suggested. So what are these two questions? From near cashless societies, do we want to go entirely cashless? So from less cash, near cashless, do we want to go patently entirely cashless? This is the first question. The second question, how do we want to cover the last mile by market-driven solutions like bank account money, like mobile money, or mobile wallets, bank accounts, and so on, cards, pretty good, UPI, QR payments, NFC, PayPass, PayWave, and so on. Pretty good solutions, pretty much potent solutions. Or we want to cover the last mile with CBDCs. And the answer to the first question, do we want to create entirely cashless societies? The answer, in my humble opinion, is yes. And the number one argument, there are multiple arguments, the number one argument is the negative interest rate channel, which I will explain to you a little bit later because it's a beautiful, fascinating topic. So to the first question, my answer is yes. Slowly, step by step, we want 100% cashless societies because that opens up the negative interest rate channel in monetary policy, which is the equivalent of antibiotics. When Sir Alexander Fleming discovered the first antibiotics, within 2 years, the life expectancy globally grew by 20 years. The same will happen in monetary policy. You will hear my argument later. The answer to the second question, do we want to cover it by existing market-driven solutions or by CBDCs? My answer is by CBDCs, because CBDCs offer a different risk category. They are direct liabilities of the central bank. There is no retail bank intermediary risk. And we want to cover them by CBDCs because central banks will want to preserve their control of narrow money, monetary base, M0, sort of cash, but in a digital format. And also, we want to cover the last mile going cashless with CBDCs, not with private money, because with CBDCs, we solve the deposit insurance problem. Anyway, it's a long story. We can go deeper later.
There's some big answers there. Ritesh, perhaps the same sort of open question to you, either on the retail side or on the more institutional side. Where do you see the big advantages of CBCDs?
Charles, advantages are phenomenal, especially as I said, in the wholesale side, it's a lot more in implementation today, and we are seeing use of it day in and day out in wholesale. In the retail side, the adoption is significantly slow. As I said, the reason for the slowness is the customer is looking for why we want to adopt a digital cash when we have got a different payment solution. So uh, whether the CBDC is a solution for today or it's for the future. So yes, it's a phenomenal concept. It's a phenomenal projects which are in preparation as well as in testing today, and they are for the future. But let's talk about what is the need for today, right? The need for today, why we are not ready for the CBDCs as of today. As I gave you an example about digital rupee, right? The CBDCs in India, the overall circulation is around 260 odd million and dollar, and that's all. While you look into the transaction on the UPI, it's around 500 million transaction a day or even more, right? So the number of transactions as well as the rotation when you see in the payment, if the payment infrastructure is robust, then yes, we don't need it today. But we can definitely go ahead and try and test because it's a time-taken process. But let me just pick up on what David said around financial inclusion side as well as the last mile delivery. The challenge that I see with the whole gamut in the digital payments as well as going cashless society. So I'm of the privy of we are going towards a less cash society rather than the cashless society in the future. The reason is because we as a when I say we, I'm talking about the global population, right? We are not ready yet. When we look into the digital divide, that's a significant. If we just pick up a one country, let's say India, right, that is representing 17.5+% population of the world, right? Yes, we have got a significant adoption of payment infrastructure, but are we really ready digitally for other form of the currencies as well? And I'm talking about India where the infrastructure is significantly strong and robust, especially in last decade or so. Let's talk about the different reasons, right? UK, Europe for that matter. Europe is going more on the mobile payments. The transactions have gone through the roof. If I'll tell you about the numbers on a Black Friday while I was leading Visa at 2010, 70 to 80 million transactions a day at Visa in Europe, we used to think like, oh, that's great. And that's next to nil today, right? That's gone exponential. So but let's talk about the financial inclusion. We need to educate people. They need to understand. And that's where the buck stops. And at the same time, they need to be digitally enabled as well. So are we really digitally enabled globally? No, we are far-fetched. So yes, it's a slow adoption. It will take time. But in terms of the CBDC as a project, that's phenomenal in terms of the use cases.
We can also, and I've got to pick you up on this idea of the negative interest rate issue because I don't understand it. What do you mean?
All right, so this is one of the most beautiful things where innovation, fintech, banking, central banking, and the future of finance come together. So what happened after the 2008 financial crisis? Central banks around the world tried to stimulate the economy. They tried to cut the interest rates. But as major central banks de facto cut rates to zero or near zero or even slightly below zero, they hit a glass ceiling. They hit, well, not ceiling in this case, let's call it glass floor or something like that. A glass bottom. Why? Because if you lower interest rates, nominal interest rates as a central bank, below 0.75% per year, i.e. 75 basis points negative, then entities, not only private families, but also big corporations start to withdraw their liquidity from the banking system and they start to keep physical cash because the cost of large scale physical cash logistics, holding, insurance, security, physical logistics is around 75 basis points per year. So if rates, nominal rates go below that, then there is a bank run. And no central banker wants to create a bank run, induce a bank run. Therefore, monetary authorities, central banks around the world had to look for something else. They maxed out the negative interest rate channel because it's limited. Positively, interest rates can go up wherever we want them to go up. We see some extreme examples internationally. Now, they tried to do quantitative easing, for example, because they couldn't stimulate the economy enough through the interest rate channel. What is the result of this quantitative easing now, pushing money to the market? Inflation. Inflation across the USA, the UK, the European Union, and beyond. Now, if there is no cash in the economy, zero cash, patently cashless economies, then can families, can corporations run and withdraw their electronic money liquidity, bank account money liquidity, and hold it in cash just because rates are negative? No. And therefore, the negative interest rate channel becomes symmetric. Rates can go high on the positive side and reverse mirror low on the negative side. And this creates a new power for monetary policy never before seen throughout human history. And this can create a new level of balance, a new level of harmony, a new level of counter-cyclical monetary policy, which can create a new level of financial stability. This is the penicillin, the antibiotics of monetary policy.
Okay, wow. There's a lot to take in there. We actually have a question from the audience, which I think absolutely relates to this. Tracy Coolidge, asks, what are the likely instabilities to the financial system that a rush to CBCDs could speed up? David, it sounds as if you're kind of countering that and saying, no, it actually adds another golf club to the armory of the central bankers. Ritesh, how are you seeing this? I mean, do you buy David's theory? And what do you think about the connection between CBCDs and the stability of the financial system?
What David said sounds great, but at the same time, let me just put my 2 pence over here. From the corporate and wholesale perspective, it definitely makes sense, right? But when you think about the retail side again, I would not agree to that. The reason is when the inflation's high, right, and when the economy is stretched, at the same time, at one hand, the government is trying to push the funds into the economy, but at the same time, you are trying to strap out the retail customers. And that will not go very well, in my opinion, because at that point of time, you really don't want to charge negative interest to the customers, right? If I'm getting it right. But at the same time, it definitely works in terms of the wholesale and the corporates. On the other hand, the question that I see in terms of the financial stabilities or instabilities to the financial system that could rush to the CBDCs. So monetary authority have been very careful over the period of time, and they have never been so careful as they are today. And for obvious reason, because there was a change in terms of the way money exchange hands today from the fiat to the cryptos, right? And back into the parallel system, which is not so regulated as well. So yes, there was a challenge with the financial instabilities. There's a challenge with the lot of other factors. Those are malicious factors, whether you talk about the terrorism, whether you talk about any illegal activities where the different currencies, or we call them cryptocurrencies, could be used in a very easier way. And that's where, yes, that could rush the CBDCs. And that's what rushing the central banks towards the CBDCs. And that's why there are so many programs run by the International Bank of Settlements or the different central banks together at this point of time, because they want to overcome the challenges of the privacy, the security of the infrastructure, as well as the financial systems. So yes, those are the main reasons. That's why they are rushing towards the CBDCs. And if you say whether it is going to give them something in return, very straightforward. Yes, it's a cost saving. It brings the operational efficiency. All right, it's a significant amount of investment in the infrastructure. And as David said earlier, I'll take a pause. Am I still audible?
Yeah, Ritesh.
Okay. Yeah.
Coming through fine.
I was just checking in. So, as David said earlier, regarding the distribution model could be very different directly from the central bank to the retail banks or the various intermediaries. There are various distribution models for the CBDCs, and that is debatable as well.
Okay, I've got to ask you guys, because this comes up all the time, the privacy issue. The retail CBCDs are objected to by civil liberties groups who say that the government will be able to view who's got what where. Now, on the plus side, it makes criminal activities harder, but the idea that the government could restrict what you could spend your money on, or could switch off your account or seize your assets, it does seem like the opposite of Bitcoin, which is supposed to offer privacy, security, a centrally controlled currency. Does seem to put a lot of hands in the government. David, do you find credibility in these accusations?
Well, I think that most of the time, most of the time, legal entities are conducting absolutely well-intended money movements and monetary transactions. There is a minority share of transactions, a minuscule minority compared to all the movements of value which are fraudulent, not well-intended. Still very serious. That's the global world of crime. And sovereigns, states, central banks, monetary authorities will have to practice self-control, self-restraint, basically legally regulated levels of serious suspicion of serious fraud can trigger the states to look into these money movements. So the states will have to voluntarily give up a certain reasonable amount of their control power. So basically, they will have to practice self-control, self-restraint. And when there is serious, credible suspicion of serious crime, it's absolutely essential that all money movements can be traced immediately. So it's a good tool for law enforcement, bad news for big-time criminals, and a balance will be imposed voluntarily and by voter pressure on sovereign states in this sense.
David, I like your optimism requiring the government to express self-censorship. Well, do we think the Chinese government is likely to do that? The Chinese Communist Party are going to exercise self-restraint? Optimistic, in my opinion. Ritesh, what do you think? I mean, India has a strong tradition of sort of civil liberties, but how do you see it? I mean, from what David was saying, he was trying to reassure me. He just made me more nervous. How do you feel?
To be honest, I wouldn't say you are any different than the normal individual who are adopting CBDCs today, because the questions are like, hey, it's a digital cash. I understand the anonymity, right? Or whether do I have a privacy? And that is the biggest concern, right? So that as I said earlier at the start, the education is a major challenge as well. But let's be realistic about the control, right? We talk about in the global markets, we have got open banking in play, and customers is okay to give their consent to share their data with third parties, which is happening today, and they are very well doing it. UK European markets pretty prevalent, and in Asian markets as well as in US as well. The regulation might be different from the regulatory compliances perspective, but it is happening. So as long as customer understand the challenges and the benefit it associates with, they are okay with it. I don't see a significant challenge. But the problem, the major problem that I'm seeing in the economy is where the adoption is a challenge, is because the customer have not been educated properly. And the same thing goes with the open banking as well. I'm pretty sure David would agree to a certain extent on that. We have seen a significant challenge with the open banking adoption in early days, but the benefits are immense. So the customer understand and they follow. And while we are here, we are talking about the financial inclusion or the literacy. Let me give you just a bit of UK market, right? So as Infinite, when I was about to build a product and start a company, we have done a market research with 30,000 subjects across the country, right? Across the UK, with the various demographics, broader demographics. What we figure out? 78% people in the UK, they don't know when they make a minimum payment on their credit card, they incur higher interest rate. 78% people. And that's the level of financial literacy in a developed economy like UK. What do we expect from global markets? And that's the reality. That's a stark reality in global markets. So we need to educate our customer first.
Yeah, I love this idea. And perhaps you guys can educate me a little more. I mean, there are a number of different models for these currencies. Now, some are explicit about using blockchain. Others are much more coy. In fact, I think the Bank of Spain launched one for its bond market. It really wasn't clear what the underlying technologies were. So, David, have you seen any kind of winning technologies that work? You know, are they based on existing cryptocurrency blockchains as sort of layer 2 solutions? Are they inventing their own blockchain? What is the most successful model that you've seen? I appreciate it's a really technical question.
Right. I mean, it can be blockchain based, or it can be central counterparty, sort of traditional ledger based. Both models are legitimate. Probably the same CBDC can have both formats coexisting to a certain extent. My humble opinion is that in the mid run, blockchain can evolve into a superior technology due to its multi-layer security, robustness, immutability characteristics, and due to the growing intensity and severity of cyber attacks against central counterparty clearing systems. Now, I want to address something very important here. Why wholesale CBDC experiments, such as the one you have mentioned on behalf of the Spanish central bank, operating sort of under ECB, the European Central Bank, are going so much better, so much easier, sort of more successful, less questions, more answers type of way than the retail CBDC pilot projects, experiments, and design. The reason for this is that wholesale CBDC is rather similar to reserve account liquidity held by financial institutions at the central bank. It's not so much different. Yes, it can be blockchain based. Yes, it can be programmable, like in the article that you have just quoted, where they are experimenting with fixed income bond payments and the coupon payments and the redemption, the final payment of a bond can all be programmed through smart contracts or other characteristics of programmable money, as opposed to sort of traditional central bank digital liquidity, which is rather dumb, so to speak. Retail CBDCs are very different compared to cash, what they are supposed to substitute. And answering the question from the audience very, very briefly, one sentence. Retail CBDCs will have to be fine-tuned, not to be superior, not to be inferior compared to bank account money, mobile wallet, e-money. It has to be equally desirable compared to other forms of money. Otherwise, the fiat currency, the national currency, splits, and or there is an unintended bank run away from bank account liquidity to CBDC. So central banks will be very careful.
Gosh. And really, my final question to you guys is what we can expect to see over the next 5 years. We've had 5 years of experimentation. There's been some soft launches, but user base is tiny. There are some interesting institutional applications, but I'm sensing from the pair of you, I should be bracing myself for big things. Ritesh, what do you think? Next 5 years, what are we going to see?
So next 5 years, we'll see the CBDC's wholesale adoption at par, of any other form of the currency today. And in terms of the retail, we will see a lot more adoption of the CBDCs globally, and the form will change. The way the projects have been run, whether it's eNeva or digital rupee or in China, we will see in the different economies, the form of the CBDC rollout as well as the adoption will increase over the period of time. But again, I will reiterate that we are not going towards a cashless economy. It will be less cash and the migration from the mobile payments to CBDCs. That's what we would be seeing.
Big stuff. And David, next 5 years, what are we bracing for?
Right. First of all, difficulties, question marks, issues will rise about cryptocurrencies. They are very innovative, but very much non-compliant. I am simplifying here. Second of all, in accordance with this, we will see multiple central banks joining together and sort of experimenting together through international organizations like the Bank for International Settlement, also on bilateral, trilateral, G20, on every different levels. We call it multi-central bank digital currency pilots and experiments. And third of all, we will not see entirely cashless societies in the next 5 years, no, but we will see increasing intensity of discourse, debate, talk, discussion, narratives about the concept of entirely cashless societies.
Well, guys, David, Ritesh, thank you so much for those insights. I'm going to say you've almost converted me. I began this discussion highly skeptical of central bank digital currencies. There are so many potential flaws, so many political objections. But as David, you've pointed out, the negative interest rate argument, and as Ritesh has pointed out, just the applications could be, in your word, phenomenal. So I'm leaving with an open mind. I have modified my view, if not completely. So I hope our audience as well have learned something. I certainly did, especially about central banking today. So Ritesh, David, thank you so much for joining us. And to our audience, thank you again for joining FinTech Talk.
Thank you.
Thank you.